Okay, so we're just gonna dive right into it. Here are 5 tips to help you become a better stock trader for 2020. When you're first starting out, you should always trade blue chip stocks, and here's why. The majority of investors know blue chip stocks have stable earnings. During an economic downturn, investors may turn to these safe havens because of their secure nature.
I secure the bag, then I go get it. Yeah.
Blue chip companies offer security during periods of slow growth due to their intelligent management teams and ability to generate stable profits. With keeping that in mind, you generally know that your money is a lot safer and more secure. With that, you know that blue chip stocks generally do not have a drastic spike or a decrease in their value. Once you're comfortable reading charts and deciding what stock you would like to buy, I would suggest testing everything you've learned on MarketWatch. The reason being is you don't have to be emotionally invested with your said money, and you can practice trading on there for free. So now we're going to look at how news can affect a stock. In general, good news and bad news will always normally cause people to buy and sell stocks. The way a stock moves is the more people buy it, the higher the price. The more people that sell it, as in a huge sell-off, the lower the stock will go. So positive news will normally cause individuals to buy stocks, i.e. good earnings reports, an announcement of a new product, corporate acquisition, positive economic indicators all translate into buying pressure and an increase in stock price. Here's why you should not do penny stocks. According to the WW Down stocks written by Brian Bears, penny stocks are high-risk securities with small market capitalizations that trade for a low price outside major market exchanges. A lack of history and information, as well as low liquidity, make penny stocks more risky. For this reason, you do not want to do penny stocks because they're extremely volatile, and more than 90% of people don't make money doing penny stocks. Here's why when first starting out, you should always keep it simple and not do shorting, options, or puts. A fundamental problem with shorting is the potential for unlimited losses. When you buy a stock in the usual way, you can never lose more than your invested capital, and your potential gain, in theory, has no limit. And as for options, when investors purchase call options instead of buying shares at their desired strike price, they essentially choose to highly leverage their returns. While it greatly increases the profits in the positive scenario, it also multiplies the losses in the adverse scenario. For instance, when the investors buy in at the money call option and the underlying stock falls or remains flat, all the invested capital is lost. In other words, the trade results in a 100% loss. On the contrary, when investors purchase a stock and the stock falls, the losses are limited while they are also mitigated by the dividend payments. The contradiction between the shares and call options becomes even more pronounced if an investor buys out of the money calls.
Thank you for watching my video. Make sure to like, subscribe, and comment for more future content.